In 1973, the S&P 500 began to trend lower as investors perceived geopolitical risk increasing in the Middle East. The Yom Kippur War of 1973 started right here in October, right after a brief bounce in the stock market, and ultimately led to a massive 40% decline on the S&P 500 over the next year as a result of surging oil prices during that period, a direct consequence of the war. Now fast forward to January of 2022, and the S&P 500 also declined as investors perceived rising geopolitical risk in Eastern Europe. The invasion of Ukraine began in the months of February and March, right after a brief bounce in the stock market, and ultimately led to a 20% decline in the stock market over the next year as a result of skyrocketing energy prices, again a direct consequence of the war in Eastern Europe. Today, we've seen global markets correct violently over the last couple of months. This is right as we see news headlines regarding a potential war breaking out in the Middle East. Though many people today believe that the drawdown that we've seen in the stock market is related to rising geopolitical risk in the Middle East. And if history is any indication, it could mean that we're in for a wild ride of much larger market drawdowns with soaring inflation rates. So we're going to take a look at exactly what the market is pricing in today, and whether today's situation is in any way comparable to 2022 or 1973. One thing that we love to look at in these types of situations is something called the Geopolitical Risk Index. This is an index that was built in order to measure how much panic there is in media regarding the geopolitical context. This index measures 8 different categories of threats across 10 different newspapers. And this is what it looks like throughout 2023 and 2024. Now, you can see it did spike a little bit in the beginning of August when the Hamas leader was recently killed, and we can argue that this is the most significant spike in geopolitical risk since April of 2024 and before that October of 2023. Both moments when tensions in the Middle East also rose, and both instances that also coincided with drawdowns in US stocks. But if we're being objective here, you can see that the spike that we've seen more recently is considerably lower than both of these other events. And it's much lower than the spike that we saw in March of 2022 when Russia invaded Ukraine. Now, that's good news because it's telling us that nothing too serious is actually happening right now. But it's bad news because it likely means that the stock market has not priced in any geopolitical risk in the Middle East, and that any escalation in the situation could lead to a lower market. For example, when we look at the price of oil, we see that recently it's been trending down. That's not price action that reflects that financial markets are getting worried about the situation in the Middle East. If we do see an escalation, it could lead to a breakout in oil prices that have been coiling up in this tight range over the last couple of years. Now, when we add the S&P 500 on top of oil prices, you can see that every time oil prices rise, it typically leads to a drawdown in US stocks. The reason this happens is because rising oil prices directly lead to higher inflationary pressures, and we know the market doesn't like that. So a breakout in oil prices would likely mechanically lead to a lower market. But that's not all. If oil prices were to rise to $100 as a result of a war in the Middle East, which is definitely the type of move that you would see in the event of a Middle Eastern war, from our research, that would almost certainly drag the US economy into a recession. And this chart right here shows us exactly why that is. It shows us every spike in oil prices that we've seen since the 1970s, pretty much every single spike in oil above 30% was followed by an economic recession in the United States in the year that followed. The only exception was 2022. The reason we didn't see a recession in 2022 was because consumers had about $3.5 trillion in excess savings left over from the pandemic. So the economy was able to weather through the oil shock in 2022. If another oil shock were to happen today, we do not believe that the US economy would be able to avoid a recession. And believe it or not, recessions in the United States are not a good thing for stocks. The average stock market decline during a recession is about 30%. We've made the case before for why we expect stocks to fall by around 50% in the next recession. So the geopolitical situation is absolutely something to monitor today. An escalation of the situation in the Middle East equals recession equals large stock market drawdown. So we're closely monitoring this situation with our members at gameoftrades.net. One of the ways we're doing that is by looking at the price action on oil. This downtrend line that you see here is absolutely key to watch. oil prices must stay below it. If oil starts to break out like this, it's probably telling us that the situation in the Middle East is deteriorating, and this type of breakout above an important level could have a lot of momentum behind it and trigger an economic downturn in the US. Now, right now, that's not at all what we're seeing. In fact, arguably, the recent price action on oil has been more to the downside, because over the last few months, we've seen inflation expectations that you see on this chart move significantly lower. And all else being equal, lower inflation expectations is a good thing for the market, because it allows the Federal Reserve to really begin cutting interest rates. And the Federal Reserve cutting interest rates would undoubtedly have a positive impact on the stock market as long as no recession occurs in the United States. Now, identifying the exact beginning of a recession, unfortunately, is impossible. We know that we're getting close, but with the stock market still in such an aggressive uptrend, it could still be too soon to turn bearish on stocks. We've actually been getting an increasing number of signs that the stock market could be set for another leg higher. We do have quite a few recessionary bets at Game of Trades, but we were able to use this recent correction to increase our equity exposure and hopefully ride this market for what looks like another leg higher. Although we're gradually shifting our allocation towards a recessionary outlook, we do still have some aggressive bets that would perform well in the event that the recession doesn't materialize anytime soon. If you want to have access to all of our trades and equity strategy, make sure to grab yourself a membership at our website. You will not regret it.